Good day, co-learner. I am Sudhanshu Bhatt, Assistant Professor at Sanjeevani Group of Institutes, MBA Department. And today we are going to talk about the International Monetary System. Now, before we begin, it is important to understand the evolution and the historical background of the International Monetary System. The way countries handle money internationally has changed over time. From 1870s to 1914, there was a gold standard that was mostly based on markets and not much regulation. After World War I, there was a lot of inflation due to war spending and global economic changes, and the gold standard fell apart. The Bretton Woods system was created to address this instability. It was more regulated than market-based, and the International Monetary Fund helped with the adjustments. Today's system is a mix of market-based and regulated. Some big countries have a lot of foreign reserves, which can make it hard for exchange rates to adjust. This has caused problems in the past and could cause problems now with global recovery. So what are the two types of exchange rate regimes and their differences? So there's floating exchange rate regime and fixed exchange rate regime. Floating exchange rate regime, here the exchange rate of a currency is determined by the market forces of supply and demand. Under this system, the exchange rate fluctuates freely and its value is determined by factors such as inflation, interest rates, economic growth, and political stability. Central banks may intervene in the market to influence the exchange rate, but they do not target a specific rate or range. On the other hand, fixed exchange rate regime has or deals with the value of a currency which is fixed to a specific rate or range of rates relative to another currency, a basket of currencies, or a commodity such as gold. The central bank of that country will intervene in the market to maintain the fixed rate by buying or selling its currency to keep the exchange rate within the set range. This requires the central bank to hold significant foreign exchange reserves, which can limit the ability of the country to conduct monetary policy. Foreign exchange rate regime has high level of flexibility, where the market determines the exchange rate, which can result in volatility, but also provides flexibility for countries to adjust their exchange rates in response to changing economic conditions. On the other hand, fixed exchange rate regime is inflexible and the exchange rate is predetermined and provides more stability, but it also limits the ability of countries to respond to changing economic conditions. So what are the three important or the main arguments in support of floating exchange rates? They are monetary policy autonomy. With a fixed exchange rate, a government's ability to control its money supply is restricted by the need to maintain exchange rate parity. Floating exchange rates allow a government to use monetary policy to expand or contract its economy without being tied to exchange rate parity. Trade balance adjustments. Floating exchange rates allow for smoother adjustments to trade imbalances. A trade deficit would lead to depreciation in the exchange rate, making exports cheaper and imports more expensive, ultimately correcting the trade deficit. The third most important argument in support of floating exchange rate is crisis recovery. Floating exchange rates can help a country recover from an economic crisis by stimulating exports as the currency becomes cheaper. However, this can also lead to inflation from increased import prices. Now let's understand the main arguments in support of fixed exchange rates. First is the monetary discipline. Fixed exchange rates ensures that the government do not expand their money supplies at inflationary rates, which can lead to high price inflation. Advocates argue that a fixed exchange rate regime would ensure that this does not occur. Second important argument is of speculation. Critics of a floating exchange rate regime argue that speculation can cause fluctuations in exchange rates, which can damage a country's economy by distorting export and import prices. Advocates of a fixed exchange rate regime argue that such a system will limit the destabilizing effects of speculation. Uncertainty. Speculation adds to the uncertainty surrounding future currency movement that characterizes floating exchange rate regimes. The unpredictability of exchange rate movements can make business planning difficult and adds risk to exporting, importing, and foreign investment activities. Advocates of a fixed exchange rate regime argue that eliminating uncertainty promotes the growth of international trade and investment. Last and important argument in support of fixed exchange rate is the trade balance adjustments and economic recovery. Critics question the closeness of the link between the exchange rate, the trade balances, and the economic growth. They claim that trade deficits are determined by the balance between savings and investments in a country, not by the external value of its currencies. Advocates of a fixed exchange rate regime argue that depreciation in a currency will lead to inflation, which will wipe out any apparent gains in cost competitiveness that arise from currency depreciation. So you might ask yourself, which exchange rate regime is better? Now, the debate between fixed and floating exchange rate regimes is ongoing, and economists cannot agree on which is better. International businesses have a lot at stake in this debate, but the evidence is not clear on which regime is better. The Bretton Woods system of fixed exchange rates failed due to speculation, which advocates of fixed rates claim is associated with floating rates. A different type of fixed exchange rate system may be more successful in promoting stability and facilitating international trade and investment. Now, it is very important to understand what is IMF and its key roles. The International Monetary Fund is a global organization tasked with promoting international monetary cooperation, facilitating international trade, promoting economic growth and stability. One of the key roles of IMF is crisis management, particularly during times of financial crisis or economic instability. Financial assistance. This assistance can take the form of loans or other financial arrangements that help countries stabilize their economies and avoid defaulting on their debts. Defaulting on their debts, sorry. The IMF also works closely with governments to develop and implement economic reform programs that can help address the underlying causes of the crisis and promote long-term growth and stability. The second important role is monitoring and analysis of global economic trends and risks. IMF can help anticipate and respond to potential crises before they escalate. The third important point is policy advice and technical assistance. IMF helps governments worldwide to develop sound economic policy and institutions that can help prevent future crises. Lastly, promoting international cooperation and collaboration on economic issues. IMF helps foster dialogue and cooperation among governments, central banks, and other key stakeholders in the global economy. This collaboration can help prevent or mitigate the impact of economic crisis and promote more stable and sustainable growth over the long period of time. Now, this is important. How would you critically evaluate IMF's policy prescriptions? IMF loan packages come with conditions attached, which typically involve tight macroeconomic policy, cuts in public spending, higher interest rates, and deregulation of protected sectors. Now, critics argue that the IMF's traditional policies represent a one size fits all approach that may not be appropriate for every country and that it does not take into account the unique circumstances of each country's economic situation. The IMF's policies may exacerbate moral hazard, which arises when people behave recklessly because they know they will be saved if things go wrong. Critics argue that IMF rescue efforts are bailing out banks whose loan gave rise to the crisis rather than forcing them to pay the price for their risky lending practices. Critics also argue that IMF's lack of accountability and how IMF has become too powerful for an institution that lacks any real mechanism for accountability. However, supporters of the IMF argue that its policies have helped stabilize economies and prevent financial crises from spreading. For example, South Korea was able to recover fairly quickly from the crisis when its economy rebounding and inflation and employment rates falling. I hope we touched on the important aspects of this interesting topic on international monetary system. We shall be dealing with more detailed case studies and discussions within the classroom. I hope this starter was interesting and it sort of excited you towards learning more about the international monetary system. Thank you very much. Have a pleasant evening, a pleasant day. Goodbye. Take care.